Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at my dividend growth portfolio that has now surpassed a value of $186,000. And in this episode, we're going to take a look at every single company that I own, the dividend income this portfolio provides me, and my goals for the portfolio going forward over the next few years. If you're a subscriber to the channel, you know I am the Gen Z investor, and on this channel we talk about the stock market, any major market headlines, and of course we track the progress of my personal dividend portfolio as well. And if you can see from my channel, I have not uploaded video on the channel for around the past 6 months. There was a lot of things going on in my personal life that just kind of took me away from YouTube. I also purchased my first home, so I kind of stopped the major deposits I was making into this portfolio every single month in order to allocate that capital towards the purchase of my home. So you can see the value of $186,000 is pretty in line to around $180,000 value where it was just 6 months ago. So a lot has not really changed within the portfolio. I have consolidated some of the holdings, and we're going to take a look at all of that in this episode. So please hit that like button and subscribe if you already haven't done so. I plan to provide updates on this portfolio every single week and month going forward, just to share with all my recent transactions, the dividend income I collect, and of course my thoughts on the overall market and any major headlines, so your support is very much appreciated. So we're going to get started by taking a look at my Simply Safe Dividends dashboard. And on this page, you can see a lot of the key metrics for my portfolio. Of course, we have the total value of around $186,000. The annual dividend income I will collect over the next 12 months from this portfolio is at $3,426. That gives me a current yield at 1.84% and a yield on cost at 2.42% with the beta right around 1. So overall, if we break down each of these key metrics, my annual dividend income is completely passive. I don't have to clock into my job or do any work in order to earn this income. I will collect it from holding the underlying companies in the portfolio and just not selling. And due to the nature of the companies that I own, I do believe all the dividends are considered very safe, and this $3,400 will be collected into the portfolio over the next 12 months, and it will actually be higher because every single company in my portfolio is a dividend grower, so they actually increase that payment to their shareholders every 12 months. And right now you can see the current dividend yield at only 1.84% is on the lower end. A lot of people take a look at my portfolio and see this low dividend yield and call me not a true dividend investor. But you have to understand, I'm in my early to mid 20s. So right now, my plan is to build up this portfolio with some of the strongest companies on the market by companies who may have a lower current payout today, but have the ability to grow that dividend for many years going forward, along with their share price. So I do receive some capital appreciation as well. So overall, I'm looking for strong total returns by owning very strong brands that I do believe and I can forecast will be in operation, earning higher profits and higher cash flows decades in the future. So I'm not really too concerned on the current dividend yield. Over time, that will rise as I get closer to retirement. And of course, we can see my yield on cost is at 2.42%, meaning the actual dividend income I'm receiving and my yield on the cost basis of my companies is higher than the current dividend yield. That is because I've been purchasing companies over the past few years. That dividend income has been growing while my cost basis has relatively stayed the same. So my yield on cost has reached 2.42%, which is a clear sign of a dividend growth portfolio where that yield on cost has grossly surpassed the current yield overall. And my beta at 1.01 means I'm currently almost exactly in line in terms of volatility with the overall market. And if we take a look at some other key metrics of the portfolio, my dividend safety, right now, 84% of the dividend income I collect is likely to be safe, while 16% is considered borderline. But if we take a look at that 16%, it is made up of only one company, which is JP Chase, and they provide me 16% of my total dividend income. JP Chase is one of the largest portfolio holdings you will see, and right now is actually ranked as the 4th largest position in my portfolio. And although Simply Safe Dividends has them ranked as borderline safe, I do not expect or predict a dividend cut from JPM anytime soon. And of course, we can see the remaining 84% of my dividend income is considered safe, and all the companies in their relative dividend safety score is shown below. So you can see I do have many companies who have the highest score possible at a 99 and have that very safe dividend rating. And if we take a look at my historical average dividend growth, this year my portfolio as a whole is average around 6% annual dividend growth, which is in line with kind of the market trends. Over the past 5 years, the average is pretty fast at 8.6%. And over the past 10 years, my average dividend growth has been 9.6% per year if I've maintained this type of portfolio. So like I mentioned, I am looking for companies who have the ability to grow their dividend for many years in the future. So this year has been a slower year in terms of dividend growth. Even some of my very strong companies who could raise their dividend at a faster rate like Microsoft, they only chose to raise their dividend by 5%. So even for some of my largest positions who are very strong companies, they're actually doing a lot more share buybacks in the current environment and are not raising dividends at a fast rate, which has brought down my current average this year. And if we take a look over the next 30 days going forward, I do have a ton of dividend payments coming in. This is a nice little calendar that indicates my future payments, and we can see this month is very packed with dividends from Johnson & Johnson, Costco, Duke Energy, Home Depot, and many more going to be deposited into my brokerage over the next few weeks. So now if we jump over to my dividend portfolio tracking spreadsheet, this spreadsheet is available in the description of all my videos for you to take a look at any point in time, and this is the most up-to-date tracking of my portfolio all in one single snapshot. The reason I created this Excel sheet is because I own all my underlying stock positions across 4 different brokerage accounts. And the reason I use 4 is not due to security reasons, but it's really because I want to determine which brokerage I like best, and I want to test out all their different features. So I currently have all my holdings spread out across 4 different brokerage accounts, and that's why it'd be very difficult for me to display my entire portfolio across each individual one or using all 4 in one video. So because I do share this portfolio on YouTube for free, I created this Excel sheet so it'd be a one clear snapshot at any point in time of all the current positions in the portfolio so you can see how my capital is allocated. So now we're going to go through each of the individual positions. I currently own 15 companies as a whole, and I like to stick between 15 to 18 companies, 20 at the absolute max, because I find that's kind of the number where I can actually keep track of how the companies are performing quarter over quarter. Rather, if I get a portfolio that's too big where I get 25, 30 plus stocks, I kind of lose the ability to actually track my portfolio and get a clear understanding of how each company is actually performing given the current environment and what's going on in the world. So right now I currently have 15. I'm not hard locked on that number. That number will fluctuate over time if I find a good deal in the market or I determine one of my companies should no longer be part of this current portfolio. And now we're going to go through each of the holdings in my portfolio kind of one by one. I'm going to go sector by sector to share how the portfolio is allocated and the current positions that I own. So starting off at the top, we have Apple and Microsoft. These are number 1 and number 2 in terms of market value in the portfolio, and they're kind of up there by a significant margin. Microsoft has a position value of over $27,000 and Apple is closely behind with the value of around $25,000. So in total, these two positions make around $52,000 of my $186,000 portfolio, making up around 28% at this current point in time. So overall, I do believe these are two of the best companies in the world. Not much I really need to get into regarding Apple and Microsoft. I made significant investment into these companies around 2 or 3 years ago and have just been letting them sit and grow over time. I'm up around 62% in each of these positions with no plans on selling anytime soon, and I will actually buy more if they dip in the future. Then of course I do have Visa coming in the tech sector as well. I know earlier in 2023, Visa was actually reclassified in the S&P 500 from tech into the financial sector, but for my own personal weighting, I had them still grouped in the tech industry. And overall, Visa I own 48 shares worth around just under $12,000. This is the leading payment processing company. They kind of have a monopoly or an oligopoly with MasterCard and American Express in their industry, and I kind of believe they will continue to raise fees like we just have an announcement of and grow profits and revenue and cash flow many years going forward. As well, in the tech sector, I have two other players kind of in the semiconductor industry, which are Broadcom and Qualcomm. Smaller positions in comparison to Apple and Microsoft, but overall, both of these companies I do believe have the ability to grow revenue and cash flows for many years in the future. They do pay a fast growing dividend, so another investment in the tech sector, and that kind of wraps it up with 5 positions in tech overall, making up around 45% of the total value of the portfolio when you add up the value of those 5 companies, which equates to around $83,000. So we continue on to the next sector, which is financials. I have JP Morgan Chase and BlackRock. I think JP Morgan Chase is probably one of the best run banks on the planet. I think Jamie Dimon has done a great job managing the bank, and I do think even in the current market environment, JPM will do just fine. I have no risk. I don't forecast any cut to their dividend. The company is building up loan loss reserves. Overall, they are well managed and have nice capital allocations internally to ensure they aren't going to go through anything like 2008 ever again. So overall, I'm not too concerned with JP Morgan Chase. I only own one real traditional bank because I do think they are the market leader. And of course, I also own BlackRock. They are the largest asset management firm in the world, or at least within the United States, with over $10 trillion of assets under management. So overall, this company is in a significant position. I only own 10 shares with a value right around $7,000. And I'm actually down significantly in this position, down 18% or around $1,500 in BlackRock alone. Nothing's going to change. I am not going to sell out of this company because of their recent underperformance. I'm going to continue to hold, let it rebound, and hopefully grow for many years going forward. And of course, now if we continue on, the next sector that I have a position in is healthcare. I actually only own one single healthcare company, and that is Johnson & Johnson. This is a dividend king. This company's been well established. They have a dozen billion-dollar brands under their umbrella. Overall, this company continues to build out new product lines into their business that will overall expand their top and bottom line. This is just a company that is a beast. It's a dividend king. It's been around forever, and I cannot really see it going anywhere anytime soon. I plan to continue to hold the company even after their kind of sector diversion and hold them for many years going forward. Just let this be a slow and consistent payer of dividends and earnings into the portfolio every single year. Next, if we move on, I only own one single consumer discretionary company, and that is Home Depot. Of course, Home Depot and Lowe's kind of have the oligopoly in the home improvement retail industry, and I just think Home Depot is the superior company. And going forward, even though we did see a very large boom during the pandemic because of people want to renovating their internal home space, they spent a lot of money on home improvements, and Home Depot saw a major bump in their total sales and income based on this kind of increase in consumer spending on their home. And of course, right now we are going through a period in time where discretionary income has been declining, interest and inflation is very high, so overall consumers may not be taking on these projects, but I just don't see kind of a competitor that can knock Home Depot out of their market leadership position. And due to the goods sold by Home Depot, those are a lot of goods we have to go in person to buy them. You have to see them, you have to feel them, you have to take a look at how they look in the store to really get an idea of how they're going to look in your home. It's very difficult to buy a lot of the items Home Depot sells directly online, or from buying it without going to a Home Depot store, or also buying it from someone else other than Home Depot. So Home Depot does have a very strong online website as well for the products that are more commonly purchased at home, but I do think home improvement goods and a lot of their warehouse stuff will still be purchased in person. So I have no kind of concern of the shift to the digital world regarding Home Depot. And next, if we continue to power on, I have Costco, Pepsi, and Procter & Gamble. These three companies make up the consumer staple sector of my portfolio. I think Costco is probably one of the best companies in the world as well. This is the third largest position in the portfolio, worth over $20,000. And then Pepsi and Procter & Gamble are kind of similar to the same Johnson & Johnson mindset, where these are dividend kings. They have well-established brands that will continue to earn profits for many years going forward. They have irreplaceable household name products that are on the shelves of almost every store all across the world. So these are just two brands that have retail, different distribution models or different products that I think cannot be easily replaced, and I don't think will be replaced anytime soon. So these are two consumer giants that I own based on their different product lines. And Costco overall is just, I think, the best retailer on the planet. Great capital management, great expansion plans. There's a lot of countries that they have not even expanded into that they see they will going forward. And overall, this company, with their Kirkland brand, it has now become the largest private label brand on the market. Kirkland sales generated over $58 billion in the last year, which makes it the largest private label brand in the world right now, which is absolutely phenomenal. And of course, Kirkland is Costco's home brand. Then if we continue on into the utility/energy sector, I have Duke Energy and NextEra Energy. Duke Energy is pretty much a dividend play. This is a traditional utility company. They're a regulated utility. I'm not expecting any dramatic growth from this business, but what I like is they have a nice 4.5% to 5% starting dividend yield when I do buy into the company. They provide a consistently growing dividend that is either matching or slightly outpacing inflation every single year, and I'm hoping to get some minimal share price appreciation. So this company is in reality there for maybe 6 to 10% total return over the long term, most of that coming through with those nice quarterly dividend payments. And with NextEra Energy, they're entering and they have a strong position in the renewable sector. Both the companies overall only make up around 6 to 7% of the total portfolio value, to give that in perspective. So they are very small holdings, but these companies, I do believe in the utility and energy sector, are the leaders and will have a strong future going forward. And finally, the 15th and final position in the portfolio is Canadian National Railroad. This company is one of the top railroads on the market. This is actually the smallest, or one of the smallest positions in my portfolio, worth only around 2% of the total portfolio value. And with Canadian National Railroad, this is a Series 1 railroad that will continue to be operational, I can picture, for decades in the future. There's no rural railroads. They have a gigantic moat. It's going to be very hard for any small competitor to kind of take over the railroad industry. They operate as an oligopoly with Canadian Pacific and Union Pacific, and I'm a big fan of oligopolies, as you can see from my portfolio holdings. So overall, another company I do believe will provide some nice consistent dividend growth with some capital appreciation over the long term. And if we scroll down, we can see I have a nice pie chart indicating my sector diversification. As we saw, tech with around 45%. Then we have consumer staples at 22%, financials at 14%, and the remaining sectors make up a tiny position in the portfolio overall. Nothing crazy, and I do believe this portfolio is nice for where I am today. I think I have built it with 15 companies who I do believe will be operational for decades in the future, which will all be generating consistent and growing cash flows each and every year, and it will be returning that cash flow to investors in the form of a quarterly dividend payment. So overall, that is the breakdown of my portfolio. That's kind of what I wanted to do with this video back. I haven't posted in over 6 months, but I want to come back with the video explaining all of my underlying positions, share them with you, go over kind of how I'm allocating my capital currently, and any future updates I make to this portfolio, any buys, any sells, any kind of dramatic changes overall, I will share in future videos. So please hit that like button and subscribe if you already haven't done so, and I will see you in the next video. Thank you.